Hello everyone, and this is Yuvraj, working as an assistant professor in Department of Commerce, DM and DM in the department in Dr. SNS College of Arts and Science. Today we are going to see about the topic of banking in practice. Banking in practice. Under that we have some points that is in content. So we are going to say about the first point is in content. Content is nothing but we have so many contents under that. What is Reserve Bank of India? I mean RBI, it's a Reserve Bank of India. Content of RBI, it is and role of banks in economic development. What are the economic developments and role of banks? We are going to see it. Under that is what is Reserve Bank of India? So first one is what is Reserve Bank of India? The Reserve Bank of India is India's central bank responsible for managing the country's money policy, regulations, bank, issuing currency and managing foreign exchange currencies reserves. It acts as the apex institution for all matters related to money and banking in India. The RBI was established in 1935 and is fully owned by the government of India. Then, this is a monetary policy. The RBI manages the supply of money in the Indian economy to control inflation and promotion of economic growth. Banking regulation. The RBI supervises and regulates all the commercial banks and other financial institutions in India. All the commercial banks and other financial institutions in India. Current management. The RBI is responsible for issuing and managing the Indian rules. And next is foreign exchange management. Next is foreign exchange management. The RBI manages the country's foreign exchange reserve and regulates foreign exchange transactions. Government bankers acts as the bankers of the central state and state government. Bankers bank. The RBI also act as the bankers to other banks in India, providing them with financial service and acting as the lender of the last resort. The RBI plays a vital role in maintaining the stability and health of Indian financial system and supporting the country's economic development. So next is the content of RBI. So we have seen the RBI. Now is going for the content of RBI. The Reserve Bank of Indian RBI is governed by a central board directors. The board includes an official director, which is the government, and a board more than the deputy governors and non-official directors such as 10 directors nominated by the government from various flights to government of official nominated by the government for 4 directors respecting the 4 local bodies. And that is role of banks. The role of banks in Indian economic development. Bank plays a critical role in economic development by acting as intermediaries, the channels savings into investment, facilitates trade and commerce, and provide financial service and support various sectors of the economy. They mobilize public savings which are used to fund business, infrastructure projects and other initiatives and drive economic growth. Banks also play a vital role in financial inclusions, providing access to financial service for individuals and business, particularly in underserved areas. Specific roles of banks in economic development: capital formation and investment. Banks collected deposits from individual and business and then lend these funds for borrowers, effectively turning savings into investment that fuel economic activity. Financial economic sector. Banks provide loans and various sectors including agriculture, small and medium enterprises and large industries which are essentially of production, employment and overall economic growth. Next is trade and commerce facilitation. Bankers play a valid role in international trade by providing payment facilities, facilitating trade, finance and managing foreign exchange transactions. Next is financial inclusions. Banks play a significant role in promoting financial inclusions by providing access to banking services such as savings, accounts and loans to individuals as communities that were previously excluded from the formal financial systems. Employment generation. By supporting business and industries, banks indirectly contribute to job creation and reduce unemployment. Next is economic stability. Central banking through monetary policy help manage inflations and maintain economic stability, which is critical for sustainable economic development. And it is a development finance. Development finance is focused on long-term financing for infrastructure projects and other initiatives that promotion social and economic development. Next lesson. Thank you.